Imagine opening your brokerage app and seeing money hit your account every single month. Not from selling shares, not from timing the market, but from an ETF quietly paying you the equivalent of around 11% a year. That sounds like a scam, right? Or at least too good to be true. Because if earning 11% in dividends was that easy, everyone would be doing it. But here's the catch. This ETF does exist. It's legal, it's popular, and it's available to European investors. The real question is not whether it pays. The real question is what you are giving up in return. Today, I'm going to show you exactly how an active ETF can generate around 11% a year in income, why it behaves very differently from a normal, for example, Nasdaq ETF, and most importantly, who this strategy is actually for. Because for the wrong investor, this can quietly destroy long-term returns. But for the right investor at the right time of life, it can be incredibly powerful. By the end of this video, you will understand how ETFs are really working, the difference between passive and active ETFs, and why Europe was late on the active ETF party, and how one specific Nasdaq-focused income ETF works under the hood. You will also see real return comparisons, so you can decide whether income or growth makes more sense for you right now. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Let's start simple. What is an ETF in plain English and under 30 seconds? An ETF is just a basket of investments you can buy in one click. Instead of picking individual stocks, you buy the whole basket. It trades on a stock exchange like any other normal share. You can buy it, sell it, and see the price move during the day. That's it. One product, instant diversification, low effort. Now, passive ETFs. This is where most investors start, and honestly, most should stay for a long time. A passive ETF doesn't try to be clever. It simply follows an index. If the index goes up, you go up. If it goes down, you go down. No opinions, no predictions, no human trying to outsmart the market. A classic example is a Nasdaq 100 ETF. If Apple, Microsoft, and Nvidia fly, so does your ETF. Passive ETFs are cheap, boring, and incredibly effective over long periods. Active ETFs are different. Here, a manager is actually doing something, making decisions, running strategies, trying to improve outcomes, not necessarily by beating the market, but by changing the shape of returns. Less upside, more income, less volatility, or some combination of those. And this is where things get interesting. For a long time, Europe lagged behind the US when it came to active ETFs. Regulation was stricter, investors were more conservative, and frankly, demand just wasn't there. Europeans loved low-cost passive funds. But over the last few years, that's changed. Inflation, volatile markets, and higher interest rates have pushed investors to ask for a different question. Not how rich will I be in 30 years, but rather how do I generate income now without selling everything? That demand is exactly why active ETFs have exploded in Europe recently. More than 50% of new ETF launches are now active ETFs, so you will soon discover those in your brokerage account or brokerage app where you used to invest. Now let's ground this with a concrete example. The iShares Nasdaq 100 ETF physically owns the Nasdaq 100 companies. No leverage, no options, just the stocks. The total expense ratio is about 0.3% per year. It's accumulating, meaning dividends are reinvested. And historically, when tech does well, this thing absolutely flies. Look at recent years. In strong bull markets like 2023, 24, and 25, the Nasdaq delivered huge gains, explosive growth. That's the dream scenario for a passive investor. You don't need income. You don't need stability. You want maximum upside, and you're happy to wait. Now enter active ETFs we are really talking about today. The JP Morgan Nasdaq Equity Premium Income Active ETF, ticker JEPQ, This active ETF holds Nasdaq-style stocks too, but then it adds to a second layer. Every month, it sells covered call options on part of the portfolio and collects option premiums. Those premiums are paid out to investors as monthly income. This is where 11% comes from. At the time of recording, JEPQ's distribution yield is roughly around 13% per year, paid out monthly. That immediately triggers alarm bells for many investors. Come on, how can something linked to the Nasdaq pay out that much income? That's impossible, right? Here's how covered calls work without jargon. Let's imagine that you own a house which you bought for 100,000 euros. You agree to sell it at a higher price, let's say at 105,000 euros, within the next month if someone wants it. For giving them that right, they pay you upfront cash today. That cash is called the option premium. If the house doesn't reach that price, you keep the house and you also keep the cash. If it does, you sell it at the agreed price and you miss out on further upside. Quite similar to car insurance. You pay insurance premium, so if you crash your car, the insurance company pays you. That's exactly what JEPQ does with stocks. In this case, they are the insurance company which gets the premiums. The ETF owns the shares. It sells call options. It gets paid premiums. Those premiums become your monthly income. The trade-off is simple, but actually quite brutal. When markets go sideways or slightly up, this strategy shines. You collect income while growth investors actually gets quite frustrated. But when markets rip higher, like they did in recent tech years and tech rallies, you lag behind. Because your upside is partially kept because you constantly have to sell your shares at a higher price, then buy them back again and again. Now, let's put numbers on that. Over the last year, a passive Nasdaq ETF has delivered around 16.45% in total return. JEPQ delivered around 12.43%. Still solid, but clearly lower. Over 3 years, the gap gets wider. Around 118.98% for the Nasdaq ETF versus about 86.49% for JEPQ. This is not a flaw, this is the design. JEPQ is not trying to win a bull market. It's trying to convert volatility into cash flow. So when does this make sense? If you are, let's say, 25 years old, building wealth and investing for decades, this ETF probably makes no sense at all. You want growth, you want compounding, you want the Nasdaq to do its thing without limits. Although, if you manage to save, let's say, around 150,000 euros in a high-paying job for some years, and you want to take a year off, but you need reliable income, this ETF could also be ideal for you. Also, if you're approaching retirement, already financially secure, or planning a period where you just want to live off your portfolio without selling assets, this suddenly becomes very, very interesting. Imagine you want to take 2 or 3 years to travel, slow down, or simply enjoy life. You don't want to sell shares in a bear market. You want income, actually monthly income. That's where JEPQ can fit. It's also psychologically powerful. Getting paid every month reduces temptation to panic sell. It turns your portfolio into something that feels productive, not just a number on your screen. But there's a final twist most people miss. This is still equity risk. JEPQ can fall hard. In a crash, both Nasdaq ETF and JEPQ go down. The income partly reduces the blow, but it does not eliminate risk. This is not a bond substitute. It is still an equity income strategy. So the real decision is not which ETF is better. It's what problem am I trying to solve right now? Growth or income? Accumulation or distribution? Future wealth or present lifestyle? If you understand that trade-off, this ETF stops looking like a gimmick and starts looking like a tool. Active income ETFs like JEPQ can generate around 11% a year, sometimes a little bit higher, but selling covered call options on Nasdaq stocks. That income comes at a cost of capped upside. In strong bull markets, passive Nasdaq ETFs always win and always will win. In flat or volatile markets, income strategies can shine. For investors near retirement or those who wanting to fund life without selling assets, this can be incredibly useful. For long-term growth investors, passive ETFs remain hard to beat. probably it will never ever be able to beat those ETFs. If you want to understand when income strategies make sense and when they don't forget to subscribe to the channel, and also don't forget to hit the like button to help the YouTube algorithm. See you next time.